Welcome to our webinar. I'm Kelsi Borland. I am a commercial real estate journalist and your host for today. Our topic is navigating rising debt costs in real estate development, understanding interest rate trends and borrowing categories. So I'm excited to talk with you today. It's going to be a really kind of packed presentation, so we'll try to go through here. This is our agenda. We're going to be talking about everything from why interest rates matter, why the topic matters. We're going to go through the kind of benchmark rates, 10-year treasury yield, and really give you some perspective here on where we've come from with interest rates and where we're heading. The goal for today is really just to give you kind of a foundation to better understand interest rate metrics and kind of know what metrics you should be using to track debt costs, and also what metrics the banks are using to set debt costs. And I think that will give you some really valuable insight into your own investment strategy and when you are vetting and underwriting a deal yourself before taking it out to market and then eventually building out your capital stack. So let's dive in. Let's get started. First, let's talk about why interest rates matter for developers. Interest rates, of course, determine your borrowing costs, which are really obviously important element to your total kind of financial and structure and investment in a development project. They impact everything from a project's feasibility or viability to asset pricing, and they can really determine whether or not you can make a deal happen. And I think we've seen that in this last couple of years as interest rates have ticked up. We've seen development pipelines shrink in response. And so it's kind of really important to know what interest rates are and what trends around interest rates are. One of the things that I think is really important to note is that it isn't just whether or not an interest rate is high or low. In the last couple of years, the market has been really characterized by volatility and uncertainty because of this pace at which interest rates increased. And so I think that is another kind of important note here, that's why this information is so important, is it kind of helps you find your footing when you are in an unstable or uncertain environment. And beyond an individual deal, interest rates also, I think, are a really good indicator of economic activity and investor sentiment. And they can really help you kind of determine what your risk appetite is. I think as commercial real estate developers, you're of course looking over kind of a 2 or 3 year horizon line from the time that you start development to time you break ground to delivery and the exit of an investment. And so there's a lot more speculation in real estate development than real estate investors take on. And I think that's why it's also important to note interest rates outside of your own capital costs. They are also just a good indicator of economic activity and risk. And I just wanted to kind of note this quote here. It says, "The market is shifting, but those who adapt can thrive." And I think that's really kind of the cornerstone of what we're talking about today. This is not interest rates are high, we can't do a deal anymore, we have to kind of sit on the sidelines. It's really about understanding trends and borrowing costs, understanding new economic trends. And some of those trends might be temporary, some of those might be longer lasting. But if you can understand them and adapt to them, you can still make a lot of deals work. You can still be active in the market. All right. So what does rising rates actually mean? We hear that term a lot. Interest rates rising, interest rates rising. You see it in headlines. Usually when people are like really super focused on rising interest rates, they're really talking about the Fed funds rate. That's what you see when you see it in headlines all the time. Interest rates are up, interest rates are down. They're talking about the Fed funds rate. We're going to get deeper into what the Fed funds rate is later, but it's essentially the rate that banks borrow against overnight reserves. And so it sets the bank's lending cost. So it's kind of that baseline interest rate, and you'll see all other interest rates set against that interest rate. So it affects every single interest rate. We are obviously going to be talking about mortgage rates and construction loan costs today, and that's really what this audience is focused on. But the Fed funds rate actually impacts everything from business loans to the interest rate that you see on a savings account at your bank, every single interest rate. So it's important to follow. That's kind of what we're talking about when we say rates are rising. There are 3 key benchmark rates that shape borrowing costs. It's not just the Fed funds rate. The Fed funds rate is probably the most important one. It's certainly the most watched benchmark, but there are two others that are also important that I want to talk about today. They're the prime rate, which is the interest rate that banks offer to their most creditworthy customers. This is the lowest rate that you could see at an individual bank. And then there is SOFR. That is actually a benchmark rate that is priced off of actual transactions. There are different SOFR benchmarks most people use over the last 30 days, but there's a 90-day and 180-day SOFR benchmark. And that's very valuable because it's actually based off of real pricings in the market. This is a great graph, I think, to note because you'll see that the Fed funds rate and SOFR usually trend in line with one another. And then the prime rate is usually set about 3% above the Fed funds rate and SOFR. We're going to dig deeper into each of these benchmarks right now, but this is kind of the foundation of where debt costs are going to start and some benchmarks for you to really look at and understand where pricing is going to be in the market. All right, so we'll start off with the Fed funds rate. Like I said, this is the most watched interest rate in the country. It is set by the Federal Reserve or the Federal Open Market Committee. They have several meetings a year and they set a different Fed funds rate. And that Fed funds rate is, like I said, the cost that banks borrow against their own reserves every night. So every bank that is regulated needs to keep a reserve account with the Federal Reserve. They have to meet their certain regulatory reserve requirement every night. And to meet that requirement, they can borrow from other banking institutions that are over their reserve requirement. And the Federal Reserve sets the rate that they can make that exchange overnight. So essentially, all banks do this, right? So this is essentially the bank's borrowing cost. When rates are at zero or we're at zero, they can exchange reserves overnight for free. And then that really makes them have zero cost of operations, and they can kind of set their interest rate at whatever they want from there. When they have to actually pay something to borrow against reserves, it restricts their ability to lend out capital. So the Fed funds rate is really, when you think of it that way, the Federal Reserve's way of putting liquidity into the market or taking liquidity out of the market. When the bank has to charge a higher interest rate on the loan, the Federal Reserve is pulling liquidity out of the economy. They're making it more difficult for people to get access to money. When they lower interest rates, they're flooding liquidity into the economy. They're making it easier for people to get access to capital and do things like build real estate developments or start businesses or other things. So this is kind of what the Fed funds rate does. It's really a tool to control liquidity in the market and really to control monetary policy, which of course is what the Fed does. It's a very important tool and it's very nuanced. I'll say that it's set by the FOMC or the Federal Open Market Committee, which is a board of governors of Fed chairs across the country, different Federal Reserve banks across the country. The board members rotate, but they meet. It's a democratic process. They meet 9 times a year and they vote on what the federal funds rate should be. And they use a ton of different metrics to do this. Today we're going to be mainly talking about inflation because that's the main metric that we're using today to increase interest rates. But they look at several different economic indicators, from inflation to employment to GDP growth and consumer prices. And they really want to create stability in the economy. This is the main goal of the Fed. It is the main goal of the Federal Open Market Committee. There is this quote that former Kansas City Fed President Esther George made, not this last meeting, but at the end of last year. And it says, "The Fed must follow its legislative mandate. Congress has told us it is to bring prices down to a low and stable level. In the long run, this institution has to think about those objectives rather than to be swayed by outside commentary and political pressure that will come its way, as it has for its entire existence." And I thought, it's a new quote, but I thought that really just encapsulated what the Federal Open Market Committee is doing, what their goal is. They're really trying, I think Jerome Powell said something to this effect as well. They're really trying to keep their head down and do their work and really focus on the numbers and setting pricing standards. I kind of like this little anecdote. The Fed funds rate has this huge impact on the economy, and some people actually blame bad Fed move in the 1920s, 1928, 1929 for triggering the Great Depression. I think a lot of things probably went into triggering the Great Depression, but there was instability in the stock market at the time as we saw the stock crash. And the Fed looked at that and thought, oh, people are being too speculative in their spending. We should increase interest rates to deter speculative investing. And actually, because there had been so many losses in the stock market, people were already suffering from a liquidity crunch. And when the Fed decided to raise interest rates over those 2 years, they were again pulling more liquidity out of the market and really impacting businesses like the automotive industry that was really relying on some of this low cost capital, and really kind of triggered mass layoffs, a really huge economic impact, and was really kind of a part of the story of what caused the Great Depression. And I think that's a great story because it really just shows you how important some of these moves that the Fed is making and how important really the Fed funds rate is to the rest of the economy. So really, really important benchmark to watch for interest rates and really just kind of economic and investor sentiment overall. I will also point out this cartoon that I love. It's actually shared at a lot of different conferences, so maybe some of you have seen it in the past. But this is the Fed funds rate tracking since the 1970s alongside the Fed chair at the time. And it's just kind of funny that the Fed funds rate also aligns with the height of each Fed chair. So you'll see Paul Volcker, who is famously like 6'7", he's super, super tall during the Carter administration. He had to raise interest rates to like 20% to fight off inflation. And he also is so tall. So this is like the peak of interest rates, the peak of the Fed funds rate. And then you see interest rates bottoming out with Ben Bernanke and Janet Yellen when they kind of brought rates down to 0% after the 2008 financial crisis and kind of that extended period of quantitative easing after the Great Recession, and they're 5'8" and 5 feet tall. And now you see Jerome Powell is in the position. He's 6 feet tall, and you see interest rates kind of rising again. So it's just kind of a funny little cartoon and a little reminder of where interest rates have come since the 1970s, 1980s, alongside who the Fed chair was at the time. So kind of just a funny cartoon there. All right, let's talk about some recent trends in interest rates from the Fed funds rate that are really impacting deals today. So we have come off of this elongated period of low interest rates from really the 2008 financial crisis. You saw interest rates at zero for a really long extended period of time. And I think it's been about 15 years that we've seen a low interest rate environment. If you entered this industry in that period of time, you will be pretty senior into your career at this point and have only experienced a low interest rate environment, which is really saying something. So this kind of change is going to be surprising, and it's going to feel like a big shift in the market. So we saw from March 2022 to July 2023, the Federal Reserve increased rates 11 times. It was pretty shocking. I think it was destabilizing for a lot of people. The increases totaled more than 500 basis points. And then at the end of last year, the Fed started to bring rates back down. Powell said he was confident that inflation was moving down toward 2%. 2% is actually the inflationary mandate for the Fed. They're trying to always hit a 2% inflationary goal. And so he felt that inflation was moving down in that direction, lowered interest rates 3 times. We're now at about 4.25% to 4.5% Fed funds rate. We talked a little bit about all of the different things that can move interest rates. Today, inflation is kind of the big thing that everyone's watching. The Federal Reserve has a 2%, like I just said, inflation mandate that they're trying to hit. That is where they think there's the most economic growth and price stability. So if you're interested in where interest rates are trending, you should also be watching where inflation is trending. If you see really low inflation, you're probably going to see lower interest rates in an attempt to stimulate more price growth. If you see inflation ticking up above 2%, you're going to see the opposite happen. You're going to see interest rates coming up to try to suppress pricing. So if you're watching interest rates, if you're concerned about borrowing costs, this is a very good metric to watch. This chart is a great example where you will see kind of where CPI and core CPI are trending. and then how interest rates are responding. Obviously, it takes the Fed a second to respond, so they're not exactly in line, but they're pretty quick. And so you see interest rates kind of trending up as inflation trends up. As interest rates come up, you can see the CPI kind of and core CPI falling down. And this dotted line is where the Fed's target inflation rate is. We're still trying to push down to that level, which is why you saw I think it's on another slide, so we'll talk about it in a second, but why you saw interest rates stabilize in January, because inflation still has not come down to that 2% target, and the Fed really wants it to get there. So we also saw kind of a high inflation report in February come out. And so until we see inflation pushing down to that 2% mark, even though it's close, we're going to see interest rates from the Fed either stabilize or we are going to see them continue to rise depending on where inflation is. The caveat to that, I'll just say right now, since we're talking about it, is employment. If employment really is impacted by interest rates, I think that's when the Fed also begins to take its foot off the gas a little bit, because obviously we need job stability as well. So it's a balance, right? We're trying to balance things, but these are the metrics that we're really looking at to determine where our borrowing costs are going to be and what is really setting that Fed funds rate. Where interest rates headed through 2026, don't we all wish we knew? Don't we all wish we had a crystal ball? I think we would all be making completely different decisions if we did. But since this is developers, we're obviously looking out 2026, 27, 28 to try to determine what borrowing costs are going to be, not only for construction financing today, but what kind of rate environment you might be refinancing into. If you're refinancing into more permanent debt once the development is completed, and you might be taking a property through stabilization. So it's always important to try to use the information that we have today to predict where we are headed. So a lot of data out is anticipating that rates will fall below 3% or in a 2.5% to 3% range by 2026 and through 2028. So you will see rates coming down and you will see them stabilizing through 2028. I will say that this has been a really interesting period of trying to forecast where interest rates are heading. And there have been a lot of wrong predictions. If we can all remember back to January 2024, a year ago, there was kind of this now infamous report that came out from Goldman Sachs really predicting aggressive rate decreases in 2024, starting in March. I think that they predicted at the time there would be 6 interest rate cuts. That did not happen. And it was sort of immediately pulled back and revised. And then people said they would come in June. Ultimately, those rate cuts came in September. So that's just a note to say that forecasting can be really difficult. We saw those 3 rate cuts at the end of 2024. I think that got a lot of people excited about 2025. And then in January, rates stayed the same. The Fed did not cut rates. So all of this is just to say that it can be difficult to make these predictions, but the data is showing us that rates are trending in a downward path and that we can expect around 3% in 2026 through 2028. This is another look at future projections. Again, kind of noting this 2.5% to 3% rate. And then I think it's always important. We're going to talk about some of the other benchmarks right now. We're really diving in deep on the Fed funds rate right now. But this is the Fed funds rate alongside the 10-year Treasury. We'll talk more about that later. And then just kind of where mortgage rates are. I just want to remind everyone that the Fed funds rate is never going to be the interest rate. It's always going to be the baseline rate that the banks are paying. And so banks are always going to set their interest rates higher than whatever the Fed funds rate is. And there's usually a spread. That spread can fluctuate. We'll talk more about that. It's based on the prime rate as well. It's another benchmark. So then you'll see here where 30-year mortgage rates are. And I think this is just an important graph to kind of show first how they're kind of trending in line with one another. But if you see, if you go out to 2028 and if you see kind of that Fed funds rate sitting just above 2%, then you're going to see a 30-year mortgage rate just below 5%. So I think it's important to remember that spread when you're trying to price out your debt costs. So this is also interesting. A lot of this is based on sentiment. I'm always so curious about investor sentiment and outlooks. on interest rates. And I think this really shows how quickly that can change. Like I mentioned that Goldman Sachs report. This is a report from Bloomberg that was done, one survey that was done in October. This is the blue line that we see. And then another survey that was done at the end of the year. And you saw a shift in sentiment. So the blue line indicates in October of last year where investors thought the Fed funds rate was going to be. And now the purple line is this other projection. And so you see changed quite a bit, right? Sentiment just in a few months changed quite a bit. And so I think that's important to remember that a lot of this is evolving and changing all the time as you get new information that can really change what investors think. Usually in a normal market cycle, I don't think that we would see this much change in just a few months, but I think that really shows you some of the instability and uncertainty we're seeing today, that you can see quite a big change in outlook from just a couple of months down the road based on several different factors. And the reason for the change, kind of a lot of things, but I think you're still seeing pretty persistent inflation and then a very, very resilient jobs market. And so those kind of things playing together, I think have allowed the Fed to say, you know what, if the jobs market is so resilient, we can kind of keep interest rates high. The economy seems strong enough to handle it. Jerome Powell, the current Fed chair, has famously promised what he is calling a soft landing. That is a kind of economic phenomenon where you can raise interest rates without triggering a recession, which is very difficult to do. And so far, he has been able to do it. And so I think he's really playing this balancing game between bringing inflation down to where he wants it to be, making sure he's not impacting the jobs market. So every month, as he's looking at the data and seeing where jobs are, where inflation is, he's making those very nuanced decisions kind of minute to minute. And that is what has made it so difficult to predict where interest rates are going to trend. Will rate cuts slow in 2025? We've talked about this a little bit. I will say the commentary coming out of the Fed from Jerome Powell has been very interesting to watch, and it does also kind of change from meeting to meeting. And the end of 2024, I think there was a lot more confidence that we would see a lot of rate cuts in 2025, particularly in this January meeting. I think that there was something, if you had asked traders, there was some reports circulating before the January meeting that traders were saying there was near 100% confidence that there would be a rate cut at the Federal Open Market Committee meeting. There was not. And the comment afterwards was this one. Powell said, "We do not need to be in a hurry to adjust our policy stance. We know that reducing, I think this is it. I think he said reducing interest rates too fast or too much could hinder progress on inflation." So I think that really just shows you that he is making sure that they're not going too fast or raising interest rates by too much, also not lowering interest rates too quickly or by too much. And so this is really the game that they're playing. Still, despite that, most economists, most traders expect the rate will dip below 4% by the end of this year. So I think that most people can expect the Fed funds rate will still continue to trend downward, maybe just not as fast as we had hoped, but we do expect additional rate cuts this year. And I don't think any rate increases are expected at this point in time. And then I think that this is just important to know. This is changing all the time, but inflation is still sitting around 3.2%, obviously much lower than in 2022 when we kind of started on this path, but still remains above that 2% target. That's kind of always that metric that we're looking at to determine where interest rates are heading when we're guessing. And this is kind of important to put all of this into context because, like I said at the beginning, those who can adapt can thrive. And this is really a reminder that we have had high interest rates in the past. We've had much higher interest rates in the past, and we still had active investment markets. And so if you look over time, this is the Fed funds rate trend since 1955, you will see that actually the historical standard for interest rates is about on a trend line with where we are today. And today we would consider interest rates to be high. So that period, this little tiny flatlining line from about 2010 when you see the Great Recession start until about 2022 with a little blip in 2018 when they started to raise interest rates a little bit and then had to bring them back down. That low interest rate period, that is a historical anomaly if you look over the trend line. And so since 1971, interest rates have averaged five and a half, 5.42%, but about 5.5%. And so today's kind of 4.5% to 5% is really still below that historical standard. And I think that should give everybody a little bit of confidence actually to say that there is a historical precedent for interest rates to be here and you can still make deals happen. So that's, I think, the good news here, right? All right, that was the Fed funds rate. Now let's talk about the second benchmark. That is the prime rate. The prime rate is the lowest rate that a bank will charge its best, most creditworthy customer. It is usually set about 3% above the Fed funds rate. So that is a great benchmark to start to understand where your debt costs are going to be when you take a project out to the market. So remember, if you see where the Fed funds rate is, you can guess a prime rate is going to be about 3% higher than that. When you go out to the market, you can probably guess you're going to sit maybe even a little bit above that prime rate, depending on who you are, what your borrower profile is, and what your deal profile is. And we're going to get into borrower quality a few slides from now. But I also just wanted to note that when we say their most creditworthy borrower, we're really talking about a borrower that has a proven track record, a borrower that probably has an existing relationship with the bank, and a borrower that has a really good quality deal, right? Those are kind of the three things that we're looking for if you really want to kind of capture that prime rate. The prime rate right now is about 7.5% on average, but it is important to note that even though the prime rate is at 7.5% on average, every bank sets its own prime rate individually. So there's no sort of mandate when you go to a bank. You could go to a bank and they can say, we set our prime rate 3.5% above the Fed funds rate, or we've widened spreads for any number of reasons, or vice versa, right? Maybe they've lowered their prime rate below that 3% benchmark or below 7.5%. So it's just, again, a benchmark to try to understand what your debt pricing is going to be as you're pricing at a deal and as you're doing your own internal underwriting. And you can see that the Fed funds rate and the prime rate almost always move together. This top line, the blue line, is the prime rate, and then you can see both SOFR and the federal funds rate trending together on the line below. They really follow each other step by step, but that prime rate's always going to sit just a little bit higher than the Fed funds rate. All right, and the third benchmark is the secured overnight financing rate, or SOFR. SOFR is a great benchmark because it is based on real transactions in the Treasury repurchase market. And so it is an incredibly reliable benchmark for that reason. A huge amount of transactions, 900 billion. There are some estimates even as high as $1 trillion or $2 trillion that are trading daily that SOFR is priced based off of. And you will usually see your deal priced based off of SOFR, not based off of the other two benchmarks. So when you actually get your interest rate financing package, your interest rate when you go out to market, it will be priced against SOFR. SOFR, just if you're doing your own research, you might see LIBOR pop up. LIBOR was the preferred metric to SOFR until about 2017, and there was a transition, and then LIBOR was replaced completely by 2023. LIBOR was the London Interbank Overnight Rate, and it was actually based on banks' internal reporting. And so it wasn't quite as reliable because it was self-reporting, where this is based on actual transactions. So a really, really good metric also to understand where interest rates are trending. SOFR, again, almost always falls in line with the federal funds rate and a good pricing metric for that reason. All right. Those were kind of the three interest rate benchmarks that are so important to note. There's also the 10-year Treasury. So the 10-year Treasury is not an interest rate benchmark necessarily that will show you what your financing cost is going to be, but the 10-year Treasury is the rate that U.S. Treasury securities are traded at, so like T-bills or bonds, Treasury bonds. And so there are a number of different Treasury yield curves that we can look at, but they're a really important indicator of many things, of economic performance, of investor sentiment, because Treasury securities are low risk investments. That yield curve becomes really important to determining where investment activity is lying. Very interestingly, the 10-year Treasury or Treasury yields in general, it used to be more preferred for them to trend higher up. It was a sign of kind of economic resiliency, and also that you were kind of gaining this higher yield on a really low risk investment like a Treasury security. Today, the opposite is true. We actually would prefer lower 10-year Treasury or lower Treasury yields because they're also an indicator of lower borrowing costs. And I think the market today just prefers lower borrowing costs, again, because we've come off of this elongated period of 0% interest rates. So I think there's just a preference for lower borrowing costs. So today we're looking for a preferred Treasury rate of below 3%. And since 2008, you've seen the 10-year Treasury trending below about 5%. We haven't seen it move up much past 5% in that time period. And like I mentioned, there are Treasury yields because it's tracking the interest rate on U.S. Treasuries. There are yields for everything from weeks, right? Because there are kind of short-term U.S. Treasury securities. There are short-term securities and very long-term securities. And so we use the 10-year as kind of the midline benchmark for that. And this is just a really good example of kind of what you're looking for. The blue line is your normal yield curve, and that is really kind of a sign of a resilient economy for long-term rates. A flat yield curve is usually market uncertainty, but I also think that today there is a preference for a lower yield curve because it's indicative of lower borrowing costs, and I think that's what a lot of borrowers are looking for today. And then an inverted yield curve. This is not an economic webinar. We can do that one day, but we won't get too deep into this, but an inverted yield curve is actually just when short-term rates are trending higher than long-term rates. It could be an indicator of a recession. When the yield curve has inverted in the past, it has been the precursor to a recession. That is not true right now, but I think there are some concerns about a recession for that reason. So this is kind of understanding yield curves. And this is, I think, so fascinating. It's so much like the Fed funds rate, where if you look over history, the story is so much different. So this is the 10-year Treasury over the last year, just from 2024 to 2025. There has been a lot of eyes on this and a lot of concern over where the 10-year Treasury is heading, because you'll see it's kind of been playing above 4%, sneaking a little close to 5%. There was some concern that it would tick above 5%. Here you see in September and October, the 10-year Treasury dipped down, and there was excitement about that. That is directly in line with where interest rates were taken. When those rate cuts happened, the 10-year Treasury responded to that. But very interestingly, rate cuts continued through the end of the year and then stabilized in January. And you saw the 10-year Treasury come back up. So it did not stay down because of the Fed funds rate was lower. And I think that's very important to note, that this is not an interest rate benchmark like the other three that we discussed earlier, but this is a really good way to track interest rate pricing and to track economic activity and investor sentiment. And so that is interesting to note, that the yield curve popped back up despite the fact that interest rates have continued to trend down. So this is the last year. This is since 2020, right? The onset of the pandemic. And so you see the 10-year Treasury coming from kind of below 1% or kind of 1.5%, and then trending upward. If you look at this to today, if you look at this graph from this perspective, you would also say that the 10-year Treasury is just soaringly high today, much higher than it's ever been. But if you look at it over history, over a longer period of time, you will really see that we also have kind of a low 10-year Treasury compared to historical standards, right? And you'll see 10-year Treasury ticking up in the 80s. Again, that's when you saw kind of runaway inflation, really, really high interest rates. And the 10-year Treasury also reflected that as well. So it's interesting to look and to give yourself some perspective at some of these benchmarks over time. And I think that can be a really important precursor today as to where we're headed. We are headed out of this environment where we're going to see this ultra low 10-year Treasury or ultra low Fed funds rate, but we're not also heading into this soaringly high environment either. We're really heading into a period of moderation. And I think that's really the way that we should look at trends around interest rates and trends around the 10-year treasury. What I think we should be hoping for today is not low interest rates, but stability and more certainty in the market so that you can confidently price out a deal. That's really where we've seen the most challenges over this last couple of years, is that uncertain climate rather than just the actual number, the actual metric of where pricing is today. There are a number of factors outside of just those metrics that can determine your debt pricing. And one of them is supply and demand. Like everything else, you're going to see higher interest rates when there are more people trying to get a loan. You're going to see lower interest rates when there's less deal. Banks need to make money. They want origination volume. High interest rates hurt origination volume. So a lot of banks are really looking for ways to boost their originations, boost their number of deals. And so low demand, I think, has helped at least facilitate some conversation over the last couple of years. Banks really being willing to work with borrowers, particularly quality borrowers with quality deals, to see how they can make things work. I will say the kind of caveat to that, and I don't know that that will impact this particular audience that much because it's a development audience, but there is a loan maturity wall coming, or I guess we're in the middle of it, end of last year through 2028. There's like $1 trillion in commercial mortgages that are going to refinance from that 2014 to 2018 period. All of those loans are going to be priced higher today than they would have been priced when they were originally secured. And so that's going to be a difficult market for a lot of those people. It's also an opportunity for banks to say, now we have some demand. We're going to try to get as much as we can out of these deals. That also can put some pressure on refinancing costs, at least, but also some pressure on both capital availability, because there is kind of this business that banks can do just built in. So it might affect capital availability. It might affect interest rates as well. So something to really, really pay attention to, that loan maturity wall, if you're going to be in the market in the next couple of years or building out a capital stack. So that's important to note. And then the best borrowers with the best deals are always going to win the best rates. It's one reason why the prime rate is so important to note as a benchmark, because you're really pricing yourself with the prime rate against other borrowers and other borrower quality. And so it's always important to remember that if you have a proven track record, if you have a great deal, you really have a good opportunity to get better pricing. And the other thing that I want to always remind people that is very important to never forget, that banking relationships really, really matter. They really matter, and particularly in times like this, times of uncertainty, times when you need banking partners to really work with you and talk to you and walk you through a deal. And a banking relationship, you say that a lot, like lean into your banking relationships. I think people think that means like, oh, I've actually done like this project with a bank before. It doesn't actually necessarily have to mean that. If you have an account open with a bank, if you have your business account open with a bank, or if you have done any kind of deal or gotten any sort of loan with a bank before, not necessarily a giant construction project that you're doing, that's worth the conversation, because the bank knows you, and banks are always going to service their customers first before they start to dig into new business. So I always kind of lean on whatever relationships that you have. This is on the next slide, at educating your deal, but I'll say it's the second point. But I will say, as an addition to that, kind of leaning into banking relationships, I would also lean on your capital team and choose a capital team or align with a capital team that has some of those relationships built in, because that team is really going to help guide you through this period. And a great capital team is going to sit down with you, and they're going to go through every single different scenario that they can think of for your deal to see how it can work. They're going to look at different types of lenders. They're going to look at all of these metrics that we're talking about today, where pricing is, what the very best pricing metrics that you can get on your deal are. And they're going to look for ways to round out the capital stack with alternative pieces of capital. And that might be city or state incentives for development. Maybe it's tax credits. Maybe it's some other sort of bond that you can use on your capital stack. Maybe it's putting equity on your deal. They're going to look at all of these different scenarios to build out the capital stack that works best for you. And you can run through those scenarios before you actually take your deal out to market to really make sure that you get the best pricing. So that's also just as important as leaning into your banking relationships, is leaning on your relationships with your capital team. And then always remember that you as the developer are in the driver's seat here, right? The bank actually isn't an expert on real estate development or real estate investment. They are an expert on banking. And so they don't know the story or the benefits or the upside of your investment the way that you do. So make sure that you have a story to tell with your development, that you are telling that story, and that you're really educating the lender on why they should be making a deal with you. And I think that when you do that, you not only helps you close a deal, but it also helps you get the best pricing and the best financing package to make your deal work. So that is my presentation for today. Really kind of an overview of interest rates and where interest rates have been, where they're heading, really just to give you a foundation to better understand all of these metrics so that you can be more educated when you are underwriting your deal, when you're vetting a new acquisition, and to give you some confidence when you go into these conversations with lenders, with your capital team, to kind of know what everyone's talking about. So thank you so much for listening. I really appreciate everyone taking the time.